What I'm about to tell you, most financial advisors would pay to make sure you never hear it, because if you do, you won't need them. The old rules of dividend investing aren't just outdated, they're being used against you, and it stops today. Right now, while you're following the same dividend playbook they've been teaching since 1990, chasing high yields, holding for 30 years, praying the market cooperates, AI-powered investors are building passive income portfolios in months, not decades. And nobody in mainstream finance wants to tell you exactly how. In the next few minutes, I'm going to show you exactly how AI is rewriting the rules of dividend investing in 2026, and give you 3 concrete moves you can start making today, even if you're starting with $500. Stay until the end, because rule number 3 is the one the industry really doesn't want you to know. Old rule number 1, chase the highest yield. 8%, 10%, 12% dividends. Sounds incredible, until you realize ultra-high yields often signal a company in crisis, about to cut its dividend entirely. This is called the dividend yield trap. It destroys beginners every single year. Old rule number 2, just be patient. Buy and hold for 30 years. But here's what they leave out. Inflation erodes your purchasing power. Companies change, and 30 years is not a strategy. It's a prayer. Old rule number 3, diversify blindly. Spread your money across 50 stocks, and you're safe. No, spreading money across 50 mediocre companies doesn't protect you. It just spreads your mediocrity. AI is proving there's a smarter way. New rule number 1, AI doesn't chase the biggest yield number. It analyzes hundreds of data points simultaneously. Payout ratio, free cash flow, debt to equity, earnings growth, dividend history, and flags the stocks most likely to sustain and grow their dividends for years. This eliminates the dividend trap entirely, not most of it, entirely. New rule number 2, the real wealth isn't in the stock paying 10% today that never grows. It's in the stock paying 3% today that raises its dividend 15% every single year. In year 10, that stock is paying you more than the 10% yielder, and the share price has tripled. AI identifies these compounders before they become obvious to the crowd. New rule number 3. 10 years ago, this kind of stock screening required a Bloomberg terminal and a $500,000 minimum account. Today, AI tools give individual investors, people starting with $500, the exact same analysis power. The professional edge? Gone. The fund manager charging you 2% a year to manage your money? Obsolete. And they know it. Here's what this looks like in real numbers. You start with $1,000 today. You invest in AI-screened dividend growth stocks, reinvesting every dividend automatically, what's called drip investing. Assuming a conservative 12% total annual return, in 10 years, that $1,000 becomes over $3,100. And it accelerates, because every dividend reinvested buys more shares, which pay more dividends, which buy more shares. That's the snowball, and AI finds the stocks that roll the fastest. Here's your move, starting today. Step 1. Forget yield as your primary filter. Instead, look for dividend payout ratios below 60% and a minimum 5-year streak of consecutive dividend increases. That's your safety filter. Step 2. Use AI-powered screening tools to analyze dividend safety scores before you touch anything. Step 3. Start with one position, one stock, one ETF, $100. The habit of consistent investing matters more than the amount right now. That's how the snowball starts. If this opened your eyes to what's actually possible with dividend investing in 2026, hit subscribe. Because next week, I'm breaking down the exact 5 dividend stocks I'd buy right now, if I was starting from zero. And drop a comment below. What's your biggest question about investing? See you in the next one.